Welcome back to part 2 of the options trading video series on the Robinhood platform. If you guys haven't taken a look at part 1, please do so. I go through a lot of the terminology that we'll use in this video with regards to the options trading platform on Robinhood. For this video, I want to continue the example with AMD, now focusing on how you can sell off a contract. If we click on trade on the bottom right hand corner, you can see again trade options. If we click on that, we get into the options trading portal. For this particular video, I want to go into how you can sell off a contract to make money on the portfolio. Again, just briefly, I want to review. This information is in part 1, a buy order on the options trading platform. So now let's jump into how you can buy and sell options contracts on the Robinhood portal here. I want to focus on selling contracts because when you sell off a contract, you get a cash payment to your portfolio. You can make extra money on stocks you already have in the portfolio or stocks that you're potentially going to jump into in the future. Just a quick review here. Again, this is all in part 1 of the video series, the video I put out yesterday. If you buy a contract, you have to pay money to another investor. You have to pay money to Robinhood for that contract. It gives you the opportunity, but not the obligation to either sell a stock at a particular price with call, and again, C-A-L-L is much like S-E-L-L, or the opportunity, but not the obligation to buy a stock at a particular price. Again, P-U-T is much like B-U-I. So you can buy a call or you can buy a put. You have to pay money to the Robinhood brokerage account. You have to pay money to another investor, or you can sell off a contract. And when you sell off a contract, you get money credited to your account. You get an options premium that is much like a dividend payment. A certain amount of money will be credited to your account to either sell off a call contract. For selling off a call contract, you are obligated to sell a stock at a particular price, or if you sell off a put contract, you are obligated to buy a stock at a particular price. And because of that obligation, which is really on the other investor who buys the contract, whether that executes or not, you get a cash premium to your account, an options premium to your account. And again, just like the last video, there's a number of different expiration dates. Again, I went through exactly what that means on that prior video, as well as strike prices within each of the expiration dates. So let's go ahead and take an example here. Let's go out a bit. Let's do January 18th, 2019 for an example here. Again, how to sell off contracts on the Robinhood portal. Take a look on the left-hand side of the screen. You can see that there's a number of different strike prices. You can see the current price in the middle there, that gray bar, $32.37. As we go up, these are prices that are above the stock price, all the way up to, I believe, $65. And on the right there, you can see a cash premium that will be credited to your account for each contract. Each contract is worth 100 shares. And as we get closer to the current stock price, you can see that premium goes up. And as we go under the stock price, $32, for example, now it's much higher just because you'll be obligated to selling off a stock much lower than what the current stock price is. So as you can imagine, not only for the risk, but also for that difference, options premium will be much higher. If we go all the way to the bottom, $2, you can see if you sell off each contract, you'll get $30.35 credited to your account. Let's take an example of just over the stock price. If it is above the stock price, it's called in the money. If it's below the stock price, it's called out of the money. So $33 and above is in the money. $32 and below is out of the money. We click on $33, for example. You'll see now we can go into selling off a contract here. If I click on one, again, that's 100 shares for $4.25 per share. You can see a credit to the account of $425. The big thing about this is, though, you have to have the stocks in your portfolio to sell off a contract like this. If I try to execute this, you can see it says I do not have enough shares of AMD in the portfolio. Because on the Robinhood platform here, you always have to have collateral. If you are going to sell off a contract, you're going to be selling a stock at a particular price, you have to have those in your portfolio. Likewise, if you try to buy a put, again, you're obligating yourself to buying a stock at a particular price. Again, if we click on $2 here, $4.25. If I do one contract, 100 shares, be a credit of $425. But you'll see that there's a collateral that I'll have to put up. Again, I'm obligating myself to buying 100 shares of AMD at $32 per share, which equals that collateral of $3,200. So that is the basics behind how you can sell off a contract in the Robinhood portfolio. Again, I'm trying to keep these videos as simple as possible for new investors on the stock market, new investors with options trading. That's really the nuts and bolts of how you go about selling off a contract. Again, it gets a little bit more complicated with regards to the risk and reward that are kind of inherent in each of these different contracts, which we'll go through in different videos here, upcoming videos. But it's very easy to go in to sell off a call or to sell off a put in your portfolio. Again, selling off a call would be great for making extra income on stocks you already have in your portfolio. If you had 100 shares of AMD in your portfolio right now, you could say, I'd like to sell those off at $33 per share at a different expiration dates. Doesn't have to be in necessarily any particular expiration date. And by doing that, you could get $425 credited to your account. If it did get up or above $33, you would have to sell that stock off. But again, a very easy way of making passive income in the portfolio. Or let's say you want to jump into a stock at a particular price. Instead of doing a market or limit order, you can simply do an options contract. So let's do $32. If the stock did get down to that price, you would be more than happy to jump in. If you click that, you want to buy 100 shares, you would get essentially paid to make that trade. Again, you have to put up collateral for that particular trade. So if the stock did get down below $32, you would buy it for $32. You would still keep that credit of $425. But if it did not get down to that particular level, you would keep that money and then simply be able to free up that capital for another stock trade. So again, this is part 2 of a multi-part series here. I went through exactly how you can sell off options contracts, either by selling off stocks you already have in your portfolio, which is called a covered call, or a covered put here, potentially buying a stock at a particular price by doing a contract. So that's the nuts and bolts of how you can sell off a contract. Again, I'm trying to make these videos as simple as possible, not going into great depth about the risk or how you select the individual contract, but really how you can manage selling off a stock in the portfolio here. So if you have any questions about this, please let me know in the comment threads down below. Again, this is a multi-part video series. The more feedback I get, the more ideas about exactly what you guys are wanting in these videos. If you guys are confused about any particular topic in this video, please let me know down below. I'll do my best to get back to you guys as quickly as I can. If you guys have any great video ideas, please let me know as well about this video or other videos. Always looking for new stocks to jump into and research. And we'll see you guys next time.